Hello everyone, welcome to our Hong Kong R&D Center Series Part 2. I'm Henry Kwong, the tax partner of Chen. In Part 2, I'm going to talk about Hong Kong tax risk of R&D expenses. In the past, before the implementation of super tax deduction, very often Hong Kong subsidiary of MNCs already had to bear significant amounts of R&D expenses. It does not mean that lots of R&D activities are going on in Hong Kong, but it was simply a cross-border tax arrangement of multinational corporations. Thanks to the low tax rate, Hong Kong is a subsidiary of MNCs which earns significant amounts of profits. So the overseas group entities which are engaged in the R&D activities would assign the R&D expenses to be burned by the Hong Kong entity. They hope that it can help reduce the Hong Kong profits tax liabilities. However, in this video, I'm going to tell you that these kind of R&D expenses are not likely to be deductible under Hong Kong profits tax. So very often, you cannot achieve your goal. Let us start with the last slide of our Part 1 video. The upper part is about the R&D super tax deduction, which has been covered in Part 1 video. In this video, I'm going to talk about the bottom part, in which the R&D work are done by neither the taxpayer itself nor designated local research institution. In the past, R&D expenses paid by a Hong Kong company to overseas group entities are generally not tax deductible under Hong Kong profits tax. That's why I do not suggest overseas group entities setting aside their costs to the Hong Kong group companies in the form of R&D costs. The requirement is slightly relaxed in the latest DIPM 55 issued by the Hong Kong IRD. Pay attention to the bottom parts of these slides and you will notice the latest requirements for R&D costs paid to overseas group entities. R&D tax deduction will only be available in Hong Kong only if not more than 20% of the R&D work are outsourced to the overseas group entities. In other words, at least 80% of the R&D work remains to be done by the Hong Kong company itself. On the other hand, the R&D costs paid by the Hong Kong company to the overseas group entities are limited to 2 million Hong Kong dollars only. All in all, it's not recommended for a Hong Kong company to bear the R&D costs on behalf of overseas group entities. This slide shows the extract of the Hong Kong Profits Tax Return Supplementary Form S3. You can notice that the IRD is very much concerned about whether the R&D activities are done in-house or outsourced to other parties. Another important element is whether the R&D activities are done in Hong Kong or outside Hong Kong. In order to maximize the tax benefits in Hong Kong, we have the following 3 general recommendations. First of all, proper R&D tax arrangements should be in place to allocate the profits from the success of the R&D work as well as the cost of R&D work. Transfer pricing will certainly be one of your concerns, but local tax deduction rule is equally important. Second, proper accounting records should be in place to identify qualified R&D expenses eligible for super tax deduction and normal tax deduction. Lastly, documentation is most important in taxation. In Hong Kong, the burden of proof lies on the taxpayer. As such, the taxpayer has to provide documentary evidence to the IRD to support its claim. Thank you for your time in watching our Hong Kong R&D series. If you would like to obtain our PowerPoints, please sign up with your email below and you will have the access link. Meanwhile, please feel free to send us an email or schedule a meeting with us for Hong Kong and China tax advice. Thank you. Thank you for watching our video. If you want to know more about Hong Kong and China tax update, please provide your email to us by accessing to the link below. We will put you in our email list so that you can know more about our tax updates as well as our seminar invitation. Meanwhile, if you have any questions on Hong Kong and China taxation, please do not hesitate to contact us through email or the Facebook Messenger. Thank you.